The benchmark 10-year yield rate rose slightly to start the year, remaining near its highest level since late May. And our next guest says we could see investors begin to shift out of bonds and into stocks. For more, let's welcome in Clark Geranen, CalBay Investments Chief Market Strategist. Clark, it's good to see you. Let's start there with the 10-year, Clark. And we're here at 4, 5, 6. We were talking to a fixed income strategist, Clark, earlier in the show, Kathy Jones from Schwab. Kathy thought, listen, it's likely the 10-year actually makes its move back up to 5%, Clark. I'm curious, do you see that as the likely possibility? If that did happen, Clark, what would that mean for the equities market?
So we're thinking that we'll see the 10-year move up to roughly 4.75. Not sure if it's going to make it all the way up to 5. Over the past few months and over the past year, as we saw the Fed cut interest rates by 100 basis points, we also saw the 10-year yield tick up 100 basis points. So it is something that we're watching, but we think that it'll stay around the 4.5 to 4.75 over the next year. But seeing that now the yield curve has normalized, we have the 1 month below the 2-year and the 2-year below the 10-year. We've seen that spread between the 2-year and 10-year double over the past month. So for us, that's a positive sign. And there's so many tailwinds moving into this year that we have a more positive outlook on 2025 than we did of 2024.
So walk us through that a little bit. So it's a sign that investors are not as worried about a recession, for example. It also makes it less attractive for folks to hold shorter term debt. We saw that huge boom in things like CDs, right, with rates rising. Where does that money go? Do you think it will come out of those shorter term instruments, and where do you think it goes?
That money will come out of the short term and head into equities. And we've already seen that. So over the past year, a lot of investors have put their money into the short-term yields because it's a great safe haven. The risk-free rate has been roughly about 5% last year. But we're seeing investors move that into equities. And from our stance, over the next 3 to 6 months, we're planning on putting that cash to work. So as we find out more about the tariff policy and fiscal policy of the Trump administration next month, we think that with any turbulence, we're going to be putting that cash to work. So a couple of weeks ago, we saw the VIX jump 75%. So clearly, investors are feeling a sense of nervousness. And I think a lot of that has to do with the last rate cut and moving into January with the new administration. But we still think that over 2025, we're going to see double-digit returns. And although we've seen more than 20% returns in the past 2 years, if we look for the 3-year span, really we're looking at an average of 9% annualized. So we still think that there's a lot of room to run in 2025.
And in 2025, Clark, under the hood in terms of sectors, where in your opinion do I want to be positioned? Where do I want to be overweight?
So with the deregulation and corporate tax rate cuts, we still see financials as performing well in 2025. Clearly, they did great this year, over 30%. So we're seeing that as one of our top spots. Healthcare, although it got banged up this year, we do believe that 2025, they're going to have double-digit returns in the healthcare sector. And that's just from a myriad of things. Like I said, some deregulation, as well as advancements in AI and continued GLP-1 use.
What happens with technology going forward this year, do you think?
So we obviously saw the behemoth of the Mag 7 outperform this year. It drove over half of the total S&P return. Not that we are underweight Mag 7, but we did perform a rebalance at the end of the year. I think a lot of investors were looking at a rebalance towards the beginning of this year once we knew more about the Trump administration. But that being said, we did make that change now. So we did a rebalance. And I think naturally after seeing the positive 2 years, a lot of that money comes from some of the large cap growth. And we're going to be diversifying back over into some of the value. We have seen valuations stretched. And I think most people, as they perform just a normal rebalance, are going to be taking some chips off the table and moving some of that into value.
Clark,
from our perspective,
I'm sorry, go ahead,
doesn't
Clark.
mean that the Mag 7 is going to underperform.
Clark, final question. I'm just curious. Overseas, Mark, Clark, when you look internationally, are there major markets where you see opportunity?
So no, typically we like to keep under 10% in non-US stocks. And I think China is going to have a difficult run moving into next year. Hopefully tariffs are just used as a bargaining tool. We'll know full scope maybe next month, 2 months. But there are some bright spots in Japan and India. But across Europe, we are also going to be underweight there, as we just saw the Mag 7 last year pass the full value of the stock 600, which is incredible, roughly 16 trillion to 13 trillion.
Clark, thanks very much. Appreciate it.